Hello, my dear students. Today we are going to learn the continuation of accounting for liquidation of companies, which we have already taken. So let's start. A statement of affairs in liquidation. In cases of voluntary liquidation, the statement of affairs is presented at a creditors or shareholders meeting in order to outline the company's financial position. The winding up or compulsory liquidation process also requires this document to be presented. In this instance, it could be prepared by the official receiver if they are acting as a liquidator, or alternatively by the appointed IP. A realizable value of assets appears alongside the book value. Accurate realizable values are reliant on the experience and judgment of a professional third party. All assumptions relating to the valuation process should be documented so that reference can be made to them at a later stage if necessary. Detailing all business assets within a statement of affairs clarifies the company's financial position. It provides a clear audit trail which identifies whether any assets have been sold in insolvency, an offense that would be investigated by the insolvency service and may lead to director disqualification if creditors' interests have not been given priority. Procedure involved in the preparation of statement of affairs. Assets which are not specifically pledged are taken first. These are to be taken at realizable values. Calls in arrear are also treated as assets not specifically pledged. The uncalled capital is not shown as assets. Second one is, if there is any surplus from assets specifically pledged, that should be added with the realizable value of assets not specifically pledged. And the third one is, from the resulting figure, deduct the amount of preferential creditors. And the fourth one is, then deduct the amount that creditors having a floating charge. The balance will be surplus or deficiency as regards debenture holders. In this point, which is the fourth point, the amount of creditors, I have written as OD. Here OD is written, but it is off. Sorry for that. And from the balance amount obtained, deduct the amount of unsecured creditors. The resultant figure will be either surplus or deficiency as regards unsecured creditors. Last point is that if the balance amount is a surplus, the share capital is to be deducted out of that amount, or if it is deficient, the share capital is to be added with the amount. The resultant figure may be surplus or deficiency as regards members or contributories. And these are the list which to be attached with the statement of affairs. List A indicated the assets which are not specifically pledged. That means these assets are free assets. List B shows the list of assets which are specifically pledged either to fully secured creditors or to partially secured creditors. List C, it indicates the list of preferential creditors, and list D shows the list of debenture holders and other creditors having a floating charge on the assets. List E contains the names of unsecured creditors and the amount due. List F specifies the names and number and values of shares held by various preference shareholders. And list G indicates the names and holdings of equity shareholders. Finally, list H shows the deficiency or surplus in the statement of affairs that has been arrived at. And coming to statement of deficiency and surplus, prior to a company entering voluntary liquidation, alongside the statement of affairs, a pack of explanatory information will also be provided to creditors. This information will include a reconciliation of the position between the last set of published accounts and the statement of affairs, known as the deficiency account. Here, we will look at how the deficiency account can be interrupted and how it can be used to explore whether wrongful trading has taken place on the part of the director. And moving to the performer, you can see it in your textbook, page number 301. Please go through that and thank you. Afterwards, we will do the problems.